Okay, these notes are specifically over the federal income tax. And once again, this comes from the 16th Amendment of the Constitution that allows the government to take money out of our paychecks, and that's what the federal income tax is. The money that they take from our paycheck is the main source of revenue that the U.S. government collects. And it's a pay-as-you-earn system. So you'll notice when you get your paycheck, they take a little bit out every pay so that at the end of the year, you don't owe the government, $5,000, $10,000, $20,000, depending on how much money you make. When we start looking at these and doing them in class, you're going to notice there are tax brackets, and that's different ranges of income. And that means people who make less than $10,000, they don't pay anything. So you'll notice that when you go to work, you get a paycheck. At the end of the year, you file a tax return, and everything that you have paid in the federal income tax, you will get all of that money back. Now, you're not going to get Social Security back, and you're not going to get all of your Indiana state tax, but anything that you have paid to the federal government, you can count on getting all of that back. Now, as your income goes up, the percentage rate, the percentages that you have to pay goes up. This is a progressive tax. The highest tax bracket's around 35%, which means those that make a lot of money pay 35% of their income to the federal government. The marriage penalty, and we're going to do this actually in class, and it's not that they tack on an extra tax when you get married, but what happens is that because of these tax brackets, if the married couples were able to file individually, they would be in a lower tax bracket. So let's say I make $25,000 and David makes or let's say he makes $40,000. Those two amounts would fall into a lower tax bracket, but when you add those two numbers together, you get 65,000, which could potentially put you into a higher tax bracket. It means you have to pay a higher percentage. They will not let married couples file separately. There are some exceptions to that, obviously, but there's really no tax advantage to doing that. We're going to actually do some math problems with that so you'll understand what the marriage penalty is. Taxable income, what that is your gross income, which is before any taxes, and then they let you deduct exemptions and deductions. An exemption you can subtract for dependents. So because David and I have 2 children, until Derek became an adult, we could and got out of school full time, we were able to subtract him. So they give you a certain dollar amount for your children that you can actually deduct from how much your taxable income is. And we'll do a tax return so you can see exactly what we're talking about. And then a deduction, that's an amount that can be deducted from your income. If you give money to charities, if you give money to your church, if you have certain percentages of medical expenses, they'll allow you to subtract that. If you have daycare where you pay into that. So there's all kinds of things. If you donate clothing to the Salvation Army, you can keep track of the dollar amount that you think that you are contributing, and you can deduct that. Certain college expenses can be deducted. The ultimate goal, and this is really important, is to get that taxable income number as low as you possibly can get it. So you got to be aware of that. Tax credits. The government uses these to encourage consumers to act in a certain way. They give you an incentive. Several years back, they had that cash for clunkers. So if you would bring in a car that didn't get very good gas mileage and traded that in for a more fuel-efficient car, they gave you money towards that. If you do home improvements that make your house more energy efficient, they'll give you money back on your taxes, and that's just a dollar amount. David and I, a few years ago, put in a new furnace. They were giving a $2,000 incentive on upgrades to your heating. So after we calculated all of our taxes, then we were able to tack on an additional $2,000 that the government just gave us. So instead of actually owing money that year, we got a little bit money back. Taxes are due on April 15th. If you pay too much, you receive a refund. If you pay too little, you actually have to pay by April 15th. And there are several different types of tax forms, but the tax returns that you actually file, you guys would file what's called a 1040-EZ, and that's for people who are like you, don't make a lot of money, have no exemptions or deductions. It's very easy. You put down there what you make, you tell them how much you paid in taxes, and you pretty much get all that back. Then you have the 1040A, which is a little more advanced, and then the regular 1040, which your parents probably, especially if they own a home, will file a 1040. That's where you have multiple exemptions, multiple deductions, and you do what's called itemize. You want to go through, and instead of taking a standard deduction, just a flat fee that everyone can take, you actually think that if you itemize and list out all of the different deductions that you have, that's going to be more. We will be doing a tax return in class, so don't worry about that.